My name is Piotr. I'm a data scientist at a company which is called Preqin. And today I'm going to tell you about a forecasting project that I've been involved in. Let me tell you first a little bit about my company. So my company is Preqin, which stands for private equity indices. This was the original name. And this company is the leading provider of in-depth data and intelligence on alternative assets market. I expect you don't really know what alternative assets market is, so let me elaborate. Assume you buy a stock, okay? You usually buy stocks at public markets. You go to London Stock Exchange, there are bid and ask offers. You buy a stock, you get it on your account, you can sell it very easily via trading systems through London Stock Exchange. Stocks are subjected to a lot of regulations. You get annual reports. Security and Exchange Commission usually regulates those stuff, etc. But if you'd like to buy a stock in your uncle's company, which might be a viable business, maybe he employs 800 people, making good money somewhere in Indonesia or India or North America, this might be a completely legit business, company which actually has stocks, but they're not public, so you can't really buy them. However, the thing is, this can be worth a lot of money. It could give you huge returns because those small companies very often are pretty good sources of revenue. So it might make sense to use it as an investment. And the similar stuff is with private debt, which is debt issued by small companies, not traded over the counter, hedge funds, venture capital, real estate, natural resources. These are the main asset classes in alternative investments. The problem with investing in those guys is that this market is horribly untransparent. So with a stock exchange, you just go online, you go to a website, you know what the last transactions were, you know how much things are worth. You can sell your stocks within seconds, usually during trading hours. It's way more complicated if you're talking about private markets. Okay, so what my company does, it collects data about those private markets and it provides intelligence about it and insights about it. As of February, my company employs over 1,000 people. It was just 600 last year, so we're growing really fast in 13 different locations. Similarly, our data science team has grown a lot. So in November 2021, we had, I think, 12 people. At the moment, we have 16. So a part of data scientists, we employ Python developers, KTP associates, which are people who are doing a PhD and also working for us at the same time. And what you cannot see on this chart, because it comes from November, so it's basically ancient, is that we also have now 3 people who are involved in business analytics. So we basically grow at exponential pace for the past 5 years. One of the main reasons why I was involved, while I was training for AI course, so unfortunately I was hired too fast, was to help with Preqin Insight service. So this service was established as an idea to leverage our access to data. My company was originally established in 2003 and it was a data provider. By now, we have the best data in the market on alternative assets. Now, the thing is that it's a good thing to sell the data, but it's a better thing to actually sell analytics and insights. It's like selling unprocessed products and processed products. This actually has higher markups. So in 2019, we launched this insight service, and this is when we started to deliver market overviews and analytics in exchange for subscription fees. Now, the problem was that if you deliver reports which only describe the past, that's not really useful for clients. In fact, it's a little bit boring. So you're not telling people anything new. That's the problem. So what our content creators really needed is to have a view of the market that is driven by the data, consistent, backed by transparent methodology, and could provide some sneak peek in the future. So you want to first integrate all the information to be sure that what you're actually seeing is consistent. This is a big deal when you're looking at 60 different sub-markets and 5 different type of horizons. But also you'd like to have some predictive power. And this is where the necessity to generate forecasts came from, and what in particular needs to be forecasted is our view of a market volume, and in finance, a generic term for market volume is assets under management. So the market is measured by how much money people have and how much money people can invest. This drove the development of our forecasting methodology, and today I'm going to tell you about second attempt and third attempt, so two different releases of our approach to forecasting. Before I do it, I'm going to make a very small detour and tell you how I was hired, because this is what Harry asked explicitly. So the thing is, when people in my company started working on this forecasting project, the first attempt was to do it with neural networks. And this thing didn't work. So the second version, which was delivered, it was delivered in under 6 weeks. So this was a sprint, unbelievable achievement by super highly...
Recording stopped.
So this second release was mathematically correct. It had over 5,000 lines of Python code. It was well documented, optimized, deployed on AWS on our developers. It was a very nice and shiny thing. Just the problem is it delivered values which for our internal client, which is Insights team, were unrealistically low. So our client said, okay, you're generating numbers, but these numbers do not really look like something which can plausibly happen. So for these reasons, the team needed someone who could check and improve upon this existing model. And then they decided to hire somebody with experience in forecasting. And it happened so that before I serendipitously joined AI Core, excellent decision, I worked previously as a quantitative researcher in a central bank. I co-wrote a paper on ECB, European Central Bank short-term forecasting methodology. I was also lecturer at Warwick Economics department. So I did a number of things, and I had some technical skills which could be put to use. Before we jump into the design of the second release of forecasting methodology, I'd like to tell you a little bit about characteristics of the data. And part of the characteristics of the data is why these things are actually hard to forecast. So when we're looking at the alternative investment market, we see funds which are investing in different geographic locations. And we have 11 main geographic locations, which are mostly either continents or huge regions, and in 5 different main asset classes. Each selection of asset and area, so in an example, area is North America, asset can be real estate or private equity, which, as I explained, is just stocks which are not traded on the stock exchange, but they're sold privately. So each selection of area and asset gives you a submarket. And this gives us in result 55 different submarkets, and these are our forecast variables. So the problem that I'd like to solve is as follows. I'd like to know how large a market for alternative investment will be in North America, and I'm just interested in the total amount of money which is being invested by funds that buy private equity, which is privately owned stocks. So the problem that we wanted to solve is to forecast the size of those 55 submarkets by the end of December 2025. So at the time, this was like a 5-year horizon. The available data was as follows. So the data that we have here and we want to predict is yearly data. It has super low frequency. Sample size is small. So in a best case scenario, you have 21 observations. And this is because the firm was established in 2003. And the earliest data that we ever see collected from this product markets is from the year 2000. We have macroeconomic data, which is older, but the main variables come from like 2000, 2003 at earliest. But the problem is that if you forecast 5 years ahead, you're going to lose 5 observations. So in fact, these are 16 data points, which is super small. However, In some cases, it's even worse. So sometimes it's just as little as 5 points. And to make things even worse, most recent data is always incomplete. So when we create the forecast for the last year, you only see the data from the first quarter. So this is the characteristics of our target variables. For explanatory variables, we have a lot of financial data, which come overwhelmingly from our platform, which is called Preqin. We have macroeconomic data, we have macroeconomic forecasts. And these are forecasts which are pre-generated by a number of different external providers and sourced from a firm called Oxford Economics. So in this exercise, we have 3 different challenges. First one is, we want to forecast not one variable. And by the way, if any of you ever had courses in forecasting in the university, if you study economics or business, you sometimes do, they'll show you exercises like this, but they usually just do one. So here the problem is, we have 55 different variables. And in a moment, we could have 100 different variables. And we need to have one model which fits them all. So which generates plausible dynamics for all of those series. Second problem that we face is incomplete data for the last year prior to the forecasts. So we usually have just quarter 1 and quarter 2 to quarter 4 are available. The third one is textbook time series methods do not work for low frequency series with small sample sizes. So almost everything which textbooks tell people to do in time series analysis is completely useless. It just will not work. Numerical optimization will not work. Asymptotic methods which have too small samples to give you any useful results. So you have to do something a little bit non-standard and very, very simple in order to get those things working together. Before we start, let me show you an example of what we roughly want to achieve. So this is the output of the most recent release, the third release of our forecasting methodology. So what you see on this graph is the amount of money which is being invested by funds operating in North America, and these are funds which invest in private equity, so the private shares. So what you see here is the years from 2000 to 2025. The blue line shows you the data which is observed on the market. The magenta line is our forecast. Black dashed line is my proxy trend. So what we want to do is to take those blue lines and continue them somehow into the future in a way which looks plausible on a graph, makes sense economically, and it's supported by the data, and ideally not just this one single series, but also using information from other data sources. Again, let me show you what I have, and let's jump to the other stuff. So the correlation here might be a problem. I'm later addressing it slightly differently. Correlation over time isn't. If you wanted to model correlation over time, you would have to do something like ARMA or ARIMA models, and they wouldn't work on such a large sample because they are estimated through quasi-maximum likelihood. It's done numerically, it would just crash or give you completely rubbish results. So this is not feasible. Okay, so what I would probably say is, it's not the worst choice. It's possible and easy to interpret. It's fast to evaluate. There are established methods to validate it, and it's easy to use. So as a baseline model, basic regression is not very bad. However, as Laura pointed out, we have 6 parameters with 16 data points. Is pretty brave. I wouldn't prefer not to do this exercise because you are risking to have overfitting. Another thing which might happen here is something which is called spurious regression, and this is because you have variables in levels. So variables in levels are likely to be non-stationary. If your target variable can be non-stationary, and in a short time series, it's often indistinguishable from non-stationary, you may run into trouble. So you might end up having junk estimates. How are we with time? Okay, another idea. So what was done in the second release was pooled forecasts. So individual forecasts were calculated from 20 different linear models, and then we took arithmetic mean of this prediction to get a final forecast. Good idea, bad idea? Quick, short answers, please. Any opinion counts.
Good idea, it's explainable.
Yep, that's a good point. Any other stuff?
Bad idea because your junk models are affecting your final output.
Okay, that's a good point. If you know that they are junk, but if they are junk, yeah, 100%. Other thoughts? What happens if my explanatory variables are not super awesome? Is it a good thing or bad thing? Because in reality, if you have like annual data, they usually aren't. If anybody wants to chime in 10 seconds, I'm going to tell you what I thought about it, and then we'll jump to another one.
If the values are continuously growing, then the distribution which they come from will be different to the training distribution.
Okay, this is statistically valid point, but we already take in log return of a target variable. So if log return would be constantly growing, you would have something growing faster than exponential. That's not happening here. It hardly happens in reality. So that would not be a problem. Now, you might be worried about residuals in general, but this is more a regression problem. And if you have just 15 data points evaluating distribution of residuals, it's not really feasible. It's just you don't have enough data. This has some advantages, actually. So if you take average of forecasts from a number of models, what you're going to get is more stable. And this is also a way to have more information, right? Absorbed into your model. Because the problem is we can't have 5 or 6 variables in a single model because the sample is too small. So the only way to do it is to have really small model average for that. Now, the bad thing is something that I think Pete, was I correct, mentioned out. Bad models affect the forecast a lot. Or to say it differently, you don't leverage the fact that some of those models might be better. In example, more stable. And by the way, what is actually relevant here is fitness out of sample, which is probably something that we'd like to look at. Okay. Now, funny thing begins. So we had a population of models, but these 20 models were selected from a population of 25 million linear models, which were specified in different ways. Good idea or bad idea?
Bad idea because it's a very small percentage.
Okay, so what's the problem with this?
The sample size is too small?
Yeah, sample size is small. And I'm having 28 million models and I'm picking up 20. So what's bad about that?
You might pick up the outliers more likely.
Yep, this is likely. In fact, we're going to see in a moment that this is exactly what happens. Any other problems?
It's expensive.
Unbelievably expensive. Because you're running through those 28 models and you're building 27,999,980. And so computationally, it's costly. You don't want to do that. I mean, for that reason alone, I wouldn't do it, okay? Without mentioning everything. So while there might be some benefits of looking at multiple specifications, disadvantage is extremely inefficient in terms of computation time. I mean, this took 3 days on Amazon Web Services. So just running, just to throw all these results out. And another thing is that unless the size of the model population is accounted for, all your statistical tests are going to be meaningless. And the reason is if you have 100 pure noise variables, okay, complete nonsense, drawn at random, 5% of them should be significantly correlated on average at a 5% significance level with a target variable. So in sufficient large population of model, you will have a model which will have something amazing, everything amazingly significant, if you care about significance. And it might all be something what statisticians call a type 1 error. Okay, so notice that here, when I say this, when I talk about this population of model, I have point number 1, and this is that in a moment, these things will start interplaying with other points. Because it will happen that some of those choices will start interacting with each other, and we're going to get some really interesting results. So after it, in a second release, we had, first of all, okay, my point 2, some specifications contain explanatory variables in levels. So they were non-stationary. And then the top predictors were picked up on the basis of 1, in-sample adjusted determination coefficient, and p-values of a slope coefficient. Any thoughts? Good things, bad things? I'm having a large population. I have some data in levels. So some of those models will be levels, not all of them. Maybe 1% of models. Who cares? I'm picking up the top 20 models that I later average using in-sample adjusted determination coefficient and p-value of the slope. And I'm picking it from a huge population, like 28 million models. So let me show you what I think happens here. I mean, I actually confirm it, at least in some instances, but this is the main thing. So the one thing which I actually like here is this adjusted determination coefficient, because when you're looking at linear regression, usually the more variables you throw in, the better your measures of goodness of fit become. So the better the regression appears, but this is purely mechanistic result. So using adjusted regression coefficient is a small plus here. And apart from it, I see mostly problems. Because this second bit, the fact that you have variables in levels, means that you have variables which can behave like random walk. Your target, it's really short series, and it has been growing a lot. Right? This is really booming market. So it's indistinguishable from a random walk. So you are getting spurious regressions. And this will happen at least for some models. Not all of them, but for some models. Now, unfortunately, you have population 228 million models. So the fact that you have 28 million models, some spurious regressions, and in spurious regression that your statistics are going to tell you that's awesome regression, this regression works, and you pick up models on the basis of p-value, means that your best models, after you do this 28 million models, will actually be spurious and it will be statistical junk. So this methodology was plowing through 28 million models for 3 days just to pick up the worst possible models because they were spurious with probability 1, okay? Because in sufficiently large sample, this spuriousness will happen and you will pick up that model. What is even worse, if you just rank models by in-sample fit, this is in accordance to point 3, you will likely cause overfitting. But you do it in a population of 28 models, so what you'll be picking up is the most overfitted models you could possibly get, and you will be averaging them out because these are the top models. So this is the consequence of this choice. And this is one of the things which was happening. So in this case, the more doesn't mean the better. And the idea that we want to go for really many models just to find the good ones completely messed this methodology up. Okay, so now then my next point has something to do with data preparation. So, and this is about the COVID. The turnaround point of the data was Q1 2020, the middle of COVID crisis. The team decided this number will proxy as the end of year value. How much time do we have? Okay, we have about 11 minutes. So I'm actually going to spoil it. Okay, I'll give you an opportunity to answer this one, and then I'm just going to talk you through like one or more 2 points. Is it a good idea or bad idea? Just assume, okay, I've seen, remember, this is the size of a market, so this is something that usually grows over time, okay? I'm just seeing first quarter, so it's a snapshot of the data.
Bad idea because it ignores 9 months of data.
Absolutely. So if we just did it on a regular basis, your model would always tell you that it's a crisis. And this is, in fact, a way to tell your model that there's a crisis, no matter what the data is. So I applaud the idea that this was meant to be conservative, but unintended consequences is that if your target variable is something like a stock, like gross domestic product, something that grows over time, or amount of money invested, that this generates artificial crisis. And the reason is as follows. Assume you have some very, very boring process which always grows at 4% per year from the beginning of time forever. So if you use this procedure, from 2017 you have 4%, 18%, 19%, 4%. For 2020, you just take the first quarter, because who knows what happens? You have 1%, in your data you have crisis. Then you feed it to your model, and the model learns, well, we have a crisis. And this might have consequences which we don't like. My final point here is, I hope it's final, that what was required was end of 2025 forecast based on values from up to 2020. The prediction of interim years was not asked for, and therefore nobody delivered it. So advantages in simplicity, disadvantages, lost opportunity to evaluate and improve on the framework based on what you actually get in the graphs, which is a super useful thing. So these were some main things. There are some other design problems. So there was no out-of-sample validation. You don't want to validate your models just in-sample feeds, because then you get overfitting. You want to get out-of-sample. Some of variables might be used for prediction might carry very little information. It's not clear how to deal with this. Some of them might be carrying the same information. It's not really clear what the information is to begin with, so maybe we'd like to define it at some stage before we even delve into it. And in general, this model was super complex. It has a lot of interlocking parts, which couldn't be easily altered, and how these parts interacted caused this undesirable results. So basically, you get results which were not really useful in practice. By the way, a small point which is not relevant for this model, if we had longer sample, we'd use benchmarks. Because one of the problems with this types of framework is I'm generating numbers. How do I know that these numbers are good? So one way is to do out-of-sample validation. Another one is to use benchmarks, see how benchmarks are bringing out of sample, see how our model does out of sample compare. This is super important and very, very practical and very easy. So this is something which might be worth mentioning. The final point here is philosophy of model. So what the guys who designed this model had in mind is that we're going to go through those 28 million models. Surely we're going to find the good ones, right? But the problem one is that in this particular area of data science, it might be that the true model doesn't exist. And in general, financial data is very noisy and contains little information in many instances. So probably we don't have a true model. So maybe looking for a true model doesn't make sense. So instead of looking for a true model, we should be picking small bits of pieces of information from different variables and aggregating them somehow. So let me tell you how I propose to approach this problem. And this is something that you can maybe find useful. So one of the problems here is this model was done from the beginning to the end, okay? Then it had undesirable outcomes, then it was not clear what to do with it. So what I propose is an approach which is opportunistic, exploratory, and pragmatic. With opportunism, you build simple systems and develop them further only if they work. You develop, test, If this works, is great. If it doesn't work, fix it or bin it. Okay. No need to do stuff which is complicated if you do not know if it works or not. Exploratory, at every stage, use diagnostics to learn how to improve a model. Pragmatic, ideally design your experiment in such a way that it would not be possible to get unfavorable outcomes. So we want to do it by design in such a way that I'm not going to get spurious regression, no matter what. So punchline here is, if you need to fail and learn fast. So these are the main design changes that I did to this model. I used out-of-sample measures of fit, which were designed at the ensemble level. I did annualization. I weighted the forecast proportional to the out-of-sample stability. So instead of taking mean of 20 models, I checked how they perform out of sample. The better performers had higher weight, worse performance had lower weight. I binned the models which are completely uninformative. I included trend with the average deviation from 0. This guarantees that you get conditional mean roughly right, even if there's little information in your data. I used only features which are stationary. I clustered the features to make sure that the same information doesn't enter twice. I forecasted full trajectories with just 300 models. And we used commercial forecast, because commercial forecast 5 years ahead is type of variable which actually helps you most in forecasting. It's going to be 5 years ahead because there's already some expert information in it. Checked intermediate results, got additional outputs, and made the code modular. Initial running time of this was 45 minutes on laptop. And it solved the basic problems. We generated numbers which started making sense, or at least more sense. This is a huge data flow diagram. I'm not going to go through this at this stage, but I'm going to give the slides to you so that you could look at it if you wanted. This basically tells you step by step what was done with the data and how the model worked. This is my feature transformation chart. Every row variable that I had, I transposed in 30 different ways. So I picked up my transformation of choice, which was either log return or difference. Then for different horizons, so either 1, 2, 3, 4, 5 years ahead, then I accounted for time delay. I either trended it or not, and rejected all the variables which are non-stationary. So I had up to 30 differently transformed copies, and from this I picked up top third performance. So at the end I had about 14,000 features which I was using to forecasting, and I used only the top ones because I had more faith that they carried any sort of signal. Okay, this was fairly quick. So now let me show you. So this is how this improved forecasting model worked. It was not for forecasting the size of the market, but fundraising. Here we don't have the entire trajectories forecasted because the clients didn't like it that much. So I was calculating trajectories and then recalculated from them a mean or an average value that I expect for the next 5 years. This is what we're going to see on the graph. Solid magenta is an average for 2020 to 2026. Blue lines is what we have observed on the market. There should be a play button here. And we have 60 seconds for questions. Enjoy the graphs.